Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday, it's the 1st of September. My name is Russell Shaw. I'm a senior market specialist at FXCM, and I just want to draw attention to my email address, rshaw@fxcm.com. And if you'd like to correspond, that's the email address to contact me, and I'll respond as soon as I'm able to. I'm just going to go ahead and bring up the disclaimers. We'll start off with the market commentaries disclaimer. I'll leave this on screen for a few moments. Now, there is going to be a live trade today. It's going to be different though. It's going to be a live trade on a demo account, and we'll do some money management as well. I'm just going to I'm popping the registration into the chat, and if you'd like to join for that, please click on the link, and you are certainly most welcome to join. Hey Kim, nice to have you on the webinar. Good morning, Raj. James, good morning to you. Thank you very much for signing in. It is highly appreciated. Thank you everyone for joining this morning. Let's just bring up the, sorry, I was on the market commentaries disclaimer. Here's the high risk investment warning. I just want to make sure I get all the disclaimers through onto the recording. So I'll just leave the high risk investment warning on for a few seconds. Okay, and here's the market commentaries disclaimer. Okay, and just finally, we'll look at our references, MarketScope 2.0 and TradingView. Just to show you the PCE, the core PCE came through yesterday. This is the Fed's preferred measure of inflation. We're still trending down nicely. There is a flick up here from 4.1% to 4.2%. I'll just explain what's happened there. We're still on the deceleration side of zero. Where is my rectangle? Here we go. We're still on the deceleration side of zero. Okay. And as long as we stay on that deceleration side, I think the Fed will be okay. What's happened here is we have what's called a base effect. So I'll try to use sort of numbers that are just easy for us. So what the base effect does is it measures. We're looking at an annualized. So already inflation had started dropping from a year ago. So the month before this, let's just say was at 10, and then the index, when I say it was 10, the PC index was at 10. So it's just the way they compile the inflation index. And then this month it was 8. And let's just say there's a consistent number between last month and this month of 15. Okay, because it is increasing, but it's increasing at a decreasing rate, right? So you can see if we do the math between sort of a month ago and this month, you kind of get a creep up in the inflation. It's a base effect. It's a base effect. It's nothing that is going to worry the Fed. If you look at the month-on-month figure, was at 0.2%. Now, you probably will be too volatile looking at a month-on-month figure. So that I think what economists would generally do is they'll take a 3-month moving average. But the month-on-month figure is 0.2%, and if we annualize that, let me just throw those into my calculator. If we annualize that, so it would be 2.43%. So on a month-on-month basis, annualized is 2.43. That's pretty close to that 2%. I don't think we're going to get a rate hike in. I don't think we're going to get a rate hike in September. That's what it boils down to. I don't think there's any, but we've got another piece of the puzzle, and that the next piece of the puzzle is the non-farm employment change, non-farm payrolls. That's today. Okay, so that's going to be very interesting. It's expected to be lower. I think the forecast around 170,000. Hey, Howard. Good morning to you. James, yeah, there was no webinar yesterday, so we'll just continue from today. So sorry for any inconvenience caused yesterday, but no webinar yesterday. And today we'll have this one, and we'll do the non-farm employment change. Okay. All right. So I just wanted to show you the inflation looks under control. It's sticky. We're not disputing it's sticky, but it's not out of control. And then what you can do just to confirm sort of what's going on, just take a look at that US 2-year yield. Remember, that's a proxy for monetary policy. And if it's moving up, it's probably indicating hawkish, aggressive monetary policy. If it's moving down, we're looking more at kind of dovish. It really was. Let's just go through to the daily. It really was no big shakes yesterday after that core PCE came out. So nothing really sort of happening there. Okay, yeah, this is the big drop in the, this was when the JOLTS data came out. Then we had a weaker ADP, benign inflation. Let's see what goes on with non-farm payroll today. I still think that the markets are tricky because we've been running with the this theory of higher for longer, and that higher for longer kind of seems to be dissipating. But we're kind of oscillating between we're at the end of the rate cycle and higher for longer, and if we're oscillating between, it's very difficult to get a directional bead on what's going on with the US dollar. So again, we'll defer to technicals. The idea here is we're not trending, okay, and the fact that we're not trending, that's not great for us as traders. It's easier to trade a trending market than to trade a consolidation. You've got to be much more precise in consolidation. You've got to get your levels correct. We all know timing the market is incredibly difficult, some say impossible. Whereas when you're in a trend, let's say you're in an uptrend, you kind of get the automatic lift up. A rising tide lifts all boats. But what we take a look here is that we have a just 2 points out of 4, just 2 points out of 4, but we will defer to the RSI, and the RSI is above 50, so there does seem to be some sort of bullishness. Now, if there is some sort of bullishness on the weekly, can we get some sort of synchronization between the weekly and the daily chart? So we're going to go down to the daily. We don't have that synchronization just yet, but it's looking very interesting. Okay, we're in no man's land. We're in neutral. We're in neutral. Again, the RSI is above 50. It's nicely between 50 and 80. We did have a overbought condition. It wasn't terribly overbought, but it was on 80. 80 is sort of the threshold level. And we did get a sell down. We did get a sell down in the dollar. Let's just go through to, oh, this is an interesting chart. I'll do this in a moment. Yeah, I want to go to a more type of vanilla chart here. Just do some work on the hourly. Let's just go down to the hourly here. So I've gone back to this chart, just looking at it without the zones. Okay. Sorry, not the hourly, the daily. I beg your pardon. And what I'm looking for here is a potential trough. I want to see, are we getting some sort of trough in here? Let me not write in caps. Are we getting some sort of trough? And the way that we're going to measure that trough is with a reference candle reversal. Okay, so remember, there are three conditions that we need for a reference candle reversal. So let me show you what they are. There are two forms of reference candles. There is a sort of a simple, and there is a complex. We're actually getting a complex, potential complex reversal here, because I'm not sure if that's what we're going to get. I'll show you both here. The first condition is we need the reference candle to have the lowest low in at least three candles. In at least three. Okay, we've got that. There's the lowest low. And then condition two, we would need price to take out the reference candle's high. We don't have that. We don't have that. And then condition three is we'll need the candle to the right to close above the reference candle high, which of course, if we don't have condition two, it would be impossible to have condition three. So we're kind of looking for a close above this level here. This is a complex. This is a complex. What's a complex form? It's where this candle, okay, watch this very carefully. It's where the candle to the right actually is inside the reference candle. Can you see that this, I don't want to make this sort of too complex, but this candle here is an inside period. It's completely inside the range of the reference candle. That makes things a little bit more complex, a little bit more complicated. It turns sort of the simple form into the complex form. So we're getting a complex form here. I don't think it should worry you. Just keep an eye on the reference candles high. What we're looking for is we're looking for two conditions now. We're looking for price to move above that reference candles high, and then we're looking for it to close above the reference candles high. Why are we looking for the bullish? Why are we looking for the bullish signal here? It's weak. The way it's a weak form because we only got 2 out of 4 points, but we do note that the momentum is to the upside. So because the momentum's to the upside, we look to see if we get a reference candle reversal and move back into zone 1. So we're kind of trying to marry up the time zones here. If we go down to the hourly chart here, we do see there is some sort of movement on the lower time frame, but this is going to be something that you've got to just be very wary of. Remember, today is non-farm payrolls Friday. This is the most anticipated, most eagerly awaited economic release that there is, right? There's going to be tremendous amount of volatility, one would think, come the release. What time's the release? The release is 2:30 ZA, 1:30 UK. Okay, and of course, join me for that live trade on the demo. We'll do a live trade on a demo account, and we'll do some money management. We'll risk up to 1% of the demo account, see if we can get some decent results there. All right, let me just see if there's any comments coming through. James, so we're going to be starting 10 minutes before the 10 minutes before the release. So the release is going to be at 1:30 the hour, so either 2:30, 1:30. We're going to start at 20 past. We're going to start at 20 past, so you're most welcome to sign in 10 minutes before. Raz suggesting it's a pullback before the uptrend continues. Yeah, well, that's kind of what we're trying to measure here, Raj. Again, I'm going to just sort of err on the side of caution. Don't predict. Exactly, patience. You've got it. Patience. Perfect. Can I post the link? Yeah, I can post the link again. I'm sending the link again. Howard, did you get it? Just let me know if you got it. Okay. Kim, this is a tough question for me to answer. I'm actually not allowed to answer it. The question is, should we close all US dollar trades? I can't give the advice. I'm not licensed, and if I say close and the dollar carries on moving in your direction, you know, you might have a case there. So I can't answer that. What I can say is that the non-farm payroll is a volatile time to be involved in the market. It is a dangerous time to be in the market. I can't say more than that, unfortunately. All right. The hourly trade, yeah, you can see there was some movement up on the dollar, but it's hit this R1 resistance. We do have a bullish cross here. We do have a bullish cross here. I don't think much is going to happen until after the non-farm payroll. I don't think much is going to happen after the before non-farm payroll. I think non-farm payroll is what everyone's looking at. It really is the next piece in the puzzle. Remember, the job market has been particularly strong. It's actually been weirdly strong. And the reason that I say it's been weirdly strong is because the Fed has been trying to impose what's called contractionary monetary policy. Contractionary monetary policy is working when unemployment is increasing and growth is decelerating. We're not seeing that. We're actually seeing accelerated growth, and we're seeing a tight job market, and that's really confused things. But now we're seeing signs of potential slowing in the job market. The JOLTS data, the ADP data, what happens with non-farm payroll data. And I think that if we get a strong NFP print, that's going to be dollar positive. I think if we get a softer NFP print, that does play into the thesis that the Fed has sort of peaked in its rating cycle, and I think we might see a softer dollar there. So it's going to be quite an interesting afternoon when we trade the non-farm payroll. All right, let's just take a look at DAX. Just to see how it's setting up before market open. In fact, it's just gone cash open now. I'm just going to bring up the DAX. All right, so the way that I'm viewing DAX at the moment, again, I think this is quite a difficult chart. The reason that I think it's difficult is because the momentum's broken down. When you draw in a trend line, the trend line is really a measure. It's not a measure. I beg your pardon. It's not a measure of trend. It's a measure of momentum. The momentum's broken down here, but I don't think that we're trending down. So we're kind of just moving sideways. What did we say earlier? It's very difficult to trade a market that's consolidating. It's easier to trade a trending market. So we don't have the trend here. Okay. Okay, Mia, I've got your question. I'll come back to that in a moment. The way that I'm looking at DAX is just, we've got this underlying support. Take a look. The market here acted as resistance, sorry, I've grabbed the wrong study. I want this. Yeah, resistance, support, resistance turning into support. That's actually, it's called the principle of polarity. It's called the principle of polarity. But the idea here is there a reference candle? Okay, that's really I think that if we can go down just to reference candles, we are doing a good job as technical analysts. See, there's a reference candle here, but it actually fails. The reference candle doesn't have to lead into a swing, but if we do get a reference candle, there is a platform for a swing. So here's the reference candle, condition 1. We've got condition 2, and we really want to see if we get condition 3. Take a look what's happening to the RSI. It's popping 50. If we go through to the daily chart, we have gone into zone 1, and I think it's worth noting that the daily momentum is positive. We're stuck in the thickest of areas here, so there's a lot of resistance here. This is what's called, they're called stale bulls. Whoever was bullish here is now actually holding a losing position. If you bought here, you're in loss. 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 That all creates resistance. It means as we come up here, whoever's holding loss will try to get out as close to break even as possible. That's going to make trading on the DAX interesting. But we are looking to see if we get that reference candle reversal. We are looking to see if we carry on trading in zone 1. We are looking to see that the RSI is above 50. What we can do now is just see if there's going to be some sort of positivity in the EMAs and the stochastic, which we don't have at the moment. So again, patience, which is what Raj wrote earlier. If we move into the lower quintile, gee, that's going to be a pity, because it will be pushing this reference candle all the way, potential reference candle all the way back to support. So a little bit of difficulty on the DAX until we get the hourly chart really lining up with the daily, and the daily would be lining up with weekly support. I just want to go back to Mia's question. What would drive the US dollar up as a result of the non-farm payroll? It really comes down to the potential effect it's going to have on monetary policy. The question now, is the Fed going to keep rates higher for longer, or are we near the apex? Are we near the peak, and are we going to see some sort of relaxation in terms of the attitude? So what happens is, if we get a lower non-farm payroll, less pressure in the jobs market, perhaps a lower average hourly earnings, less pressure on the wage inflation, that in of itself would take a lot of pressure off the Fed. That would drive dollar down. But if we get a non-farm payroll that is higher than expected, that's showing wage inflation, I think that drives the dollar up. If they keep the rates higher, what would it mean? It would mean support for the US dollar. It would mean support for the US dollar. Does that make sense to you, Mia? What we can do is we can actually dedicate a session next week to monetary policy. We used to do Friday sessions where we discuss sort of ad hoc topics. We don't really do that anymore. But maybe we can sort of discuss some monetary policy theory next week. I'll sort of ask guys to vote on it on Monday. Maybe the week after next. Yeah, all right. I think that's where we'll leave it this morning. Are there any comments? Okay, yeah, Raj. Okay, so Raj has requested the week after next. Yeah, we'll do it the week after next. All right. Cool. All right, no comments coming in. Let's wrap up here, guys. Let's wrap up here. I want to thank you guys for joining me this morning, and I look forward to speaking and seeing you later. Yeah, James, looking forward to seeing you later. All right, guys. Cheers. See you later.